Ladies and gentlemen, hello. My name is Ben Leybovich with JustAskBenWhy.com and Source Capital, LLC. I'm joined today by Mr. Brian Burke of Praxis Capital. Now, my company focuses on strategic acquisition of multifamily in Phoenix, MSA. Brian Burke's company focuses on strategic acquisition of apartments on Earth, the Moon, and as of late, I understand Mars. I think you picked up an institutional guy. I think his name is Elon Musk. You haven't made that announcement yet, but I'm guessing this is where it's going. We're going to colonize Mars. Please keep me in mind for JV on that opportunity. I think it's going to be wonderful. This promises to be a very, very rich conversation. We are going to be discussing the dynamics that we see in the trenches today in multifamily and in syndication. Some of this may be a little bit, I don't want to say advanced, but a little bit high flying of a conversation. We have about an hour that I was able to get Brian Burke to commit to this conversation. I have very limited capacity to translate the things that he says, which may sound like Japanese to some of the listeners. Please feel free to reach out to either Brian or myself for further explanations. If you are looking to pick up additional knowledge because you want to do what we do, which is buy multifamily, listen up. If you are looking to educate yourself so as to be more effective at strategically placing capital, if you are in that camp, please listen up. There's going to be a lot of valuable nuggets in this conversation. If you just want to learn about real estate from a couple of guys that are making moves in a very challenging market environment today, listen up. With that, Brian, thank you so much for making the time to join me.
Well, thanks for inviting me to do this, Ben.
I've been looking forward to it for a little bit, but we're finally here. We're going to have a very interesting conversation. I think a lot of folks are going to benefit from what you have to say. Thank you so much for joining me. Now, guys, I took a few notes. I'm going to pronounce myself right now the moderator of this conversation because we have an hour. We have a lot of ground to cover. So I did make a few notes. If I look away from the screen, if I'm reading something, please understand I'm doing so because I'm trying to keep us on task for this conversation. I want you to visualize this talk today as a kind of a funnel. So we're going to start very wide scoped, and we're going to narrow down into specifics. We're going to start with all things economy. We're not economists. We defer to other people for all things economy. However, we do have to make calls as part of our underwriting process on where the economy is and where we think it's going to go. And we have to incorporate those calls into our underwriting fundamentally. So any conversation around real estate and syndication has to begin with looking at the economy, looking where we're at and where we're going. So we're going to start there. Then we're going to funnel this down to not really specifics, but more specific relative to multifamily. Where is the multifamily? Where's the cycle in the multifamily? What does that mean for our acquisition? So we're no longer talking about economy in general. We're talking about specifically what we see working in the marketplace as far as what we're doing. And finally, we're going to narrow down some more all the way to the kind of the mechanics. Here's a deal. Here's what the triggers are. Here's what we're looking at. Here's what specifically deal to deal on a deal to deal basis, what this looks like from the trenches, from our point of view. Okay. So that's how hopefully this conversation is going to go. I'll take it upon myself to take responsibility if we stray, but I'll do the best I can to kind of not stray. With that, Brian, I'd like to begin with a statement that I'd like you to either validate or invalidate. So yes or no, here's the statement. No matter what the economy is, it is never a bad time to buy a good deal. True or false?
Well, true. It's just that, in a bad economy, it's just very, very difficult to find a good deal because the definition of a good deal is completely different. I was buying stuff, in 2005 and 6 when the market was dropping precipitously. But what I was able to buy was a completely different product than the stuff I would buy today. And, it was all about enormously steep discounts that could be turned around and resold very quickly before the market had time to fall even further. Those kind of deals can be done in almost any market. But there are really and truly times to just take up golf, or sitting on a beach. There really are. But if you can find the right deal, you can do it.
Fair enough. I think where I'm leading you with this question is that there's always never a bad time to complain about there not being good enough deals. And I think you would agree that what you described right now is very dynamic. So in A market, definition of a good deal is X. But in B market, definition of a good deal is Y. It falls upon you as a professional within this sport of real estate to be able to stretch yourself, stretch your comprehension of the market dynamics so as to be able to differentiate between those things, define what a good deal looks like, and execute upon that which you deem to be a good deal. There are a lot of people today, Brian, who are sitting on the sidelines because they can't execute deals that were good 4 years ago. My question really boils down to, you're obviously a buyer, a very significant buyer today, just as much as you were 4 years ago. And I think you had a period of time where things weren't working, the underwriting wasn't gelling, and it took you some doing and thinking and rationalizing to figure out what was not working. You went through that intellectual exercise. That's where I'm trying to take you with this conversation. How did your underwriting change? What changed? Why did you think it was important to adapt instead of just say, it's not a good time to buy because price per door is up here versus here, and I just don't want to do that? What is it in a professional's thinking that leads you to look at yourself honestly in the mirror and ask the question, maybe it's me. Maybe my underwriting doesn't work, and it's me. It's not the market. It's me.
Well, it's always the market. The market is like it's like the weather. You can't control whether it's going to be warm or cold outside. So what you have to do is you have to adapt to whatever the weather is doing and dress accordingly. So if it's pouring rain outside, you probably, in 20 degrees, you don't want to go outside in shorts and a t-shirt. You might want to think about having a rain jacket on, right? But you look kind of funny walking around on a 110 degree Arizona afternoon in the summer with a rain jacket. So really what you have to do is you have to observe the environment that you're operating in, which in the case of a real estate investor's environment is the market. And you have to adjust your strategy. You have to adjust your underwriting to fit with what the weather is doing. And if you can sit around and complain, oh, the weather sucks, or it's too cold outside, I can't go out there, or it's raining, so I'll grocery shop tomorrow, even though we have no food in the house. At a certain point, you have to just say, I got to figure out what the right recipe is to be able to tackle this environment that I'm going to face when I walk outside my front door, and make sure that it's going to be it's going to get me to where I'm trying to get to.
Right.
And that's really what it is. I mean, your underwriting will change based upon the environment that you're operating in, and if you don't change it, then you're not gonna succeed in achieving whatever objective it is that you have.
Right. So 3 comments that come to mind, kind of descriptive comments. Pictures. I think in terms of pictures, don't be trying to stick a square peg into a round hole. Usually doesn't work very well. That's one way to kind of visualize the circumstance. Another way is to say that it probably works best to point the nose of your ship in the direction of the flow in that river or in that stream. You probably will have a much more difficult time trying to go upstream and wonder why it's not working. That's probably another good visualization of what we're talking about here. And the third is to say that the underwriting, the storytelling behind the numbers, doesn't exist in vacuum. you don't just pick up that story from one economic cycle to the other, because the story changes and the numbers have to change in order to tell the appropriate story. So when people think of underwriting, I think it's important to understand the numbers are there. The underwriting doesn't start with the numbers. It starts with the picture, with the story, and then we boil it down in terms of numbers because that's the language we use. And so those numbers change, and that underwriting changes to accommodate the fact that the story has changed. That's all it is.
Math doesn't change, right? 2 + 2 always equals 4. Math doesn't change, but context does, and context matters in the case of underwriting, because underwriting is not just math; it's assumptions,
right?
And that's where people tend to go wrong, is making incorrect assumptions. And in a market that's topping out, and everything is operating at 95% occupancy with very little credit loss, and you underwrite that way near the top of a market, you can be in for a world of hurt when you find out that the market doesn't always operate to perfection. And now all of a sudden you realize your assumptions were wrong, and that means that you didn't perform on your objectives, or worse, you completely ran out of cash and ended up having to hand the keys back to the bank. So having the correct assumptions given where you sit in the market at any given time is extremely important. And that's why you can buy a good deal in a bad market if your assumptions are correct in your underwriting, to assume that things are going to get worse, then maybe they get better.
This is also why you can buy an absolutely horrifyingly bad deal in a great market, because it's still all about assumptions. And that's probably more viable for the cycle that we're in now, is buying what will turn out to be horrible deals in what is, by any metric, a great market at the moment. Right?
It is if you're a seller. It's not a great market if you're a buyer. This is a really tough time to be a buyer, but it doesn't mean that you can't be a buyer.
Correct.
It just means that you have to be very careful about what you're buying and make sure that you have a story you can prove out and is based upon solid assumptions.
And we will discuss what that story might look like in a bit. For now, question number one on the economy. Where are we in the apartment cycle, both in the country as a whole? And I know it's kind of a ludicrous question, but I have to ask because people listening to us are probably all over the place, right? So where are we in the apartment cycle, both in the country as a whole and specifically in your markets of choice where you are a buyer? And I was going to ask, are you a buyer still? That's just me opening the door to a conversation of why you are a buyer in the market that we're still in. So where are we in the cycle, nationally and locally, and why are you still a buyer?
Well, to add some context, let's talk about whether I'm a buyer still and why. And the answer is yes, I am. In fact, I've closed 600 units since July, and I have 550 units currently in contract that'll be closing, between here and call it sometime in March.
Mm-hmm.
So yes, absolutely still a buyer. And the reason I'm still a buyer is because there's runway left in the right markets, and the fundamentals behind multifamily investments are still very strong.
Mm-hmm.
There's three things that drive multifamily values. I mean, they're driven by income. We all know that. And they're driven by cap rates. Some people on this listening here know that. Others don't. We'll get into that, I'm sure, in a little bit. But the value of that real estate, let's just assume, is driven by income. And the income of real estate is driven by three primary factors: income growth, job growth, and population growth. And if you have those three elements in a market, you have a real strong foundation for increased income from the real estate, which gives you a strong thesis for upside on valuation and upside in additional income while you're still holding the property. So that's why. But now, where are we? Well, that varies market to market. As well as the next guy, there's really good markets to be in right now, and there's, I'm sure, many good markets to not be in right now. And
Lima, Ohio is probably the number one market to be in right now, even though I happen to be in Phoenix. But, I had to plug Lima. I have to plug Lima.
You've been dissing it for so long. It's plug, I know. uh, great markets are markets like yours. Phoenix is a great market. It's a great place.
So let me jump in. So Colliers is projecting 7% rent growth in Phoenix this year. That's number one bullet point. Number two bullet point, last time I checked, national average rent is $1,470. In Phoenix, depending on who you listen to, it's between $1,040 and $1,070. Okay? So that right there is what defines the runway that you keep talking about. 3.5% growth in jobs in 2017. Okay? Low property taxes. We'll get into that. Low insurance costs. We'll get into that a little bit later. But when we start talking about cap rates and all about how the cap rates are low, when you are walking into a market with an organic ceiling that's 25% higher than where it is currently, that's why the cap rates are low, because the market participants understand this, and they understand that they can exploit that delta. And so they're willing to pay a premium for property in its current state, current net operating income. But that, I think, is what you are talking about in terms of great market. Job growth, population growth, diversified employment base, diversified logic for population growth, rents that leave a lot of room, tenants who are still able to save money because they're spending considerably less of their take-home pay on rent than nationally. Those things are what defines a great market. And if you are going to deploy this late in the cycle, you first look for safety, and then you look to make money. And that is how safety looks, with people needing services, needing places to live, and being able to afford it. Is that pretty much it?
Yeah, that's certainly 75 to 90% of it. All of those points are exactly what you're looking for. One other thing that I try to find, which is a little tough to find, but it's
called value add.
Is the value add. Yeah, that's certainly a component. I'm sure we're going to get into value add in a minute, but still talking about markets is looking for markets that are in a cycle that bloomed later than others. So, for example, I used to be a heavy buyer in Texas. We used to own a lot of product in Texas. I've owned in every one of the major Texas metros. And it was a really good market to me. But right now I'm not buying in Texas. And it's still a pretty popular place for people to be buying. But Texas was the very first market to recover when the cycle, bottomed out in the midst of the Great Recession. And that cycle has been running for a very long time. And while there's nothing wrong with that, it doesn't necessarily mean that cycle is about to end. One of the things I'm looking for right now is I'm looking for cycles that bloom later, with the thesis that there's a potential that those cycles could run a little bit longer or have a little bit more time left in them. Examples are like Florida, for example. California recovered from the pricing reset pretty quickly. Our prices now are beyond what they were when the market peaked in 2005. And, they came back relatively quick. Despite we had a ton of foreclosures, our foreclosure process in California is a 111-day non-judicial process. And, while it was taking a lot longer to complete them just because of the backlog, most of that backlog got cleared out in just a few years. Florida, on the other hand, has a system called judicial foreclosure where it can literally take years to process a single foreclosure. So this kind of dark cloud in the real estate market in Florida lasted a lot longer over there and caused their comeback to be delayed relative to other MSAs. And so, I like the Florida market because I think that it's a young cycle. And I think a young cycle right now is something that people should look for. Atlanta was another one of a semi-late bloomer. And that one's, I think, got time left in it. and Texas may prove that it's got plenty of time left because it's so strong. But right now, I just tend to like these younger cycles a little bit better.
Makes sense. Let's talk about interest rates. That's a black box. We have to make assumptions about where the interest rates are going to be, because at some point it would make sense that cap rates will normalize against the interest rates, although we haven't seen that yet. But you have to assume as part of the underwriting that eventually it'll happen. So it becomes important to kind of take a stab at where the interest rates might be on a 5-year basis, on a 10-year basis, as part of your underwriting process.
Mm-hmm.
What are your thoughts based on what the Fed is telegraphing to us and based on what you are seeing in the bond market and all of that? What I'm not asking you to guess. I'm asking you, you obviously do your research and you read people that are much smarter than yourself. What are your assumptions?
Well, my assumptions are that rates are trending up. I don't really follow too closely what the Fed is doing, because the Fed doesn't set mortgage rates on multifamily real estate. Bond market traders do. And so, what we're looking at is, what the bond market traders are saying about future interest rates. And there are futures on the LIBOR. And, given futures on LIBOR, you can get a pretty good read on where LIBOR rates are going to be. And, we use floating rate debt. So
we're going to talk about that later.
Yeah, we will. So, with our floating rate debt, the assumptions that we're using on interest rates are extremely important. And, there's two different ways that people underwrite real estate to floating rate debt. One is to kind of just set a rate, like today's rate, and hope it doesn't go up. Another is to set today's rate and add a little bit to it, assuming that way, if it goes up, you've absorbed it. What I do is I go to the experts and I get a yield curve from Bloomberg that shows what the forecasted rates are from the bond traders 10 years out on a monthly basis. And I adjust the interest rate in my underwriting on a monthly basis based upon those experts' opinions of where bond rates are going. And then I add a fudge factor to assume that, if they're wrong, it's going to cost me. So why don't I just kind of tax my underwriting up front? And then if they're right, then I get a bonus. So, I don't try to forecast interest rates. I let the experts do it, but I use their forecasts in my underwriting.
Correct. We do the same thing, but the difference between us, I think, is what we need to talk about, which is you use floating rates. We use floating bridge, refinance into a stable fixed rate. And the difference in that conversation is that in our case, we have yield maintenance or defeasance as a prepayment cost. In your case, you're paying for caps, and your calculation is that it's cheaper and more flexible to simply pay for caps on a floating rate so that you can exit anytime you want to exit, and there's no prepayment that you have to worry about. In our case, a lot of our investors, and that's really what we want to talk about, a lot of our investors want to see us get into a fixed rate. So as far as the conversations with our investors, obviously a lot of people are willing to let you float it. Out of 10, how many investors would you say you lose when you tell them you have no plans of refinancing into a fixed rate?
Maybe one.
Okay, so your guys, it doesn't bother at all.
No, it bothers some people, but it's just a lack of education is usually the reason why people completely dismiss floating rate as a viable option. And when they understand the risks of fixed rate debt, more often than not, they come around. And we've got, I'll just give you a great example. To get out of a floating rate debt costs you 1% of the loan amount. So let's say on a a $10 million loan that's going to cost you $100,000, and a cap on a $10 million loan costs me about $25,000. So there's about $125,000 in costs to get out of floating rate debt anytime we want. On the fixed rate side, I know of an owner who had to sell, or realized it was a good time to sell, and was in a fixed rate product. They had a great turnaround on their deal. 2 years, they had some really incredible upside and wanted to cash out and return capital to their investors, along with some great performance. The exit on their $12 million loan was almost $2 million. So that was the yield maintenance penalty, $2 million. So it's, if you imagine, what does 0.5% of interest rate movement cost over a 3-year hold period on a $10 million loan? If rates move up 0.5, what does that cost you? Not that much. That's your risk. Your risk is, well, geez, we might make $500,000 less. Or on the flip side, we could make $2 million less. Well, which of those two risks are you more willing to tolerate? And most people, when they see that, realize that the floating rate debt is an incredible deal. Not only is it cheaper to get out, it adds flexibility. I can react to the market without the influence of a $2 million yield maintenance penalty hanging over my head. If I think, geez, we got to sell now because the market's going to collapse, it would be real easy to say, geez, well, we really can't because we've got this $2 million yield maintenance penalty. Let's hang on for a couple more years, and the market collapses. You're like, shoot, see, I was right. We should have gotten out, but we were unduly influenced by this yield maintenance. So that's a risk that you take by going with fixed rate debt. So if we're in the value add business, our business model is to buy, add value, and then sell when the market timing is right. Fixed rate financing in the residential world is a great tool because you get a 30-year fully amortizing fixed rate mortgage on your house. You can sell whenever you want, no penalty. Life is good. It gives you that certainty. Fixed rate financing in the commercial real estate world is a whole different animal because you have yield maintenance penalties, right? And you're guaranteeing to your lender you're going to get all your payments for the whole 10 years of this loan. And if I'm on a 3-year business model where I'm going to fix up and resell, that's enormously destructive to pay essentially 10 years of interest, right, minus what they get in the bond market for that privilege.
And I completely agree, which is why we do 3+1+1 bridge with caps. And then we have a choice to make. If the market cycle is in a place where we know we're holding for 7 years, Fannie Mae 7-year fixed, here we come. But we buy ourselves up to 5 years to make the decision to get out. And that's how we kind of cater to both sides of this equation. People who are sophisticated enough to understand exactly what you've been talking about, but also folks who want to see fixed, but we're buying ourselves flexibility as sponsors to be able to accommodate both sides of this equation. But I would tend to agree with you. Being able to get out, it's a flip, right? Being able to get out is absolutely what this is about.
It is. And we're not doing anything different, by the way. I mean, it's just your 3+1+1 bridge. I'm using 7-year agency floater. I can refinance at year 3 with a 1% exit fee and refinance into a fixed rate product if we decide that that's what we're going to do. Right. We can also refinance into another 7-year floater loan, and we pay the $100,000 in exit fee, refinance to a new loan, pull cash out. Right. And then we have another 7 years. So
the point being, we have options. We have options. There's everybody thinks of value in multifamily as denominated in cash flow. The value in multifamily is denominated in options, being able to conduct business and change your business plan to accommodate the market cycle. That's where the greatest value is in what we do. And so it sounds like what you do and what we do is just basically to give ourselves latitude to be nimble and to make those calls as we go.
It's right back to what we talked about in the beginning. It's like, okay, now it's hot outside. Take your jacket off, right?
Exactly.
You have to have the ability to do that. And, the only kind of financing that's permanent is fixed financing. That's permanent. You can't get out of it. You can't change course.
Well, and I'm kind of changing the format a little bit because it just really the conversation is going there. The kind of deals I buy, the yield maintenance is simply not there for me to qualify for fixed financing out the gate. I buy such extreme value add that the net operating income of what I am assuming is not anywhere near to accommodate 1.2, 1.3 yield maintenance.
Debt coverage. Yeah, you're right. Yeah, absolutely. You can't get enough proceeds.
You can't get enough proceeds. That's the whole point of the game. So I'm kind of, as a business plan, I am forced to work with a lender who understands my business. They understand that I will raise a little more capital because I will be light on cash flow in year one, because it takes time to reposition, to raise rents by $300, to cut the bad debt by 50%. It takes time to do those things. And there are lenders out there who understand that, but they're all bridge lenders. They're all lenders who operate in this sphere. And they know that either you are going to value add and exit, or you're going to keep it, in which case you refinance into fixed rate debt. But they don't want to be around for that. They are there for a short period of time to give you the latitude to buy something that's not stable, that you can reposition, and to execute your business plan.
Yeah, and you can do that with with an agency debt too, but you're going to have 65 or 60% LTV acquisition financing. So we do the same. We go through this exercise on especially on the heavier value adds. We can get 65% from the agencies at a lower cost, or we can get 80% from the bridge lenders at a higher cost. Which one produces a higher internal rate of return to our investors, or which one is more advantageous to use in each of those circumstances? And we underwrite them both ways. And, we do some of our deals with the 3-1-1 bridge. In fact, we closed the last deal we closed with one, I think it was the same lender you used on your deal. And, those products are there for a reason.
Funny. They told me they didn't like you at all. Yeah, I don't know what they're doing lending you money.
And then ask them why they did another deal with us right after we closed the first one.
They're the guys where they want this one that we're under contract right now. Ladies and gentlemen, I'm talking to Brian Burke. My name is Ben Leybovich. Brian Burke, how many units do you have now under management? 2,000?
Yeah.
Okay. So he closed 500 in the last 3 months, and it's about to close 500 more, or whatever silly numbers those are. I closed 100 and I had 98 4 months ago, and about to close 117. So we're not. Interestingly, we're dealing with the same lender. I'm a little surprised we're dealing with the same lender because you're buying much more unit count, and I kind of thought they would want to stay on a smaller side. Maybe that's my misunderstanding of their business plan.
I've closed 3 deals with them in the last 4 months.
They're good.
Yeah.
They're good. All right, let me move on. What hold periods do you underwrite today, and why?
I underwrite to 3 different hold periods on every deal. I underwrite to a 10-year hold, a 5-year hold, and a 3-year hold. And the reason why is I call myself a buy and watch investor.
Mm-hmm.
I buy the real estate, I make the improvements I can make, and I watch the market for the optimal point to exit. And that optimal point could land at any number of different jumping off points. And so I underwrite to all of those potential jumping off points at the outset of the deal so that we can show the investor, here's 3 scenarios. Here's what happens if we can get out in 3 years. Here's what happens if we have to wait for 5 to get what we're looking for. And here's what happens if all hell breaks loose and we're stuck with this thing for 10 years, and that's when we get to exit. And ideally what I want to see is that the IRR is higher as the hold period gets shorter. And it's interesting, as you do these multiple exit strategy exercises, is sometimes you'll find a deal where the IRR actually gets lower as the hold period gets shorter. And it's just a clue that, that would mean you're paying too much.
Yeah, right. So let's just answer that question, because I have a question here to ask you, your trigger IRR to the partners. So ladies and gentlemen, understand that unless we can raise money for our deals, we have no deal. It doesn't matter what a deal flow looks like. If there's no equity to do the deal with, as a syndicator, there is no deal. So it's all a function of, you set the market. Where are you comfortable deploying your capital at? So in my experience, anything between 14 and 15% IRR on a 10-year hold, which typically looks like 18 to 19% on a 5-year hold, which looks like mid-20s on a 3-year hold, is where folks feel that there's enough value add. Because let's face it, most of it is the back-end appreciation, that value that we're creating in the deal. That's what drives the lion's share of that IRR. That's where people feel comfortable deploying, and that's where people are okay parting with their cash and putting it in the deal like this. Do you, Brian, see those kind of targets, 14 to 15, 17, 18, 19, and then mid-20s on a 3-year? Do you also see that those parameters hold true for your investors, or where are your guys at?
Well, it's everybody is different, and some people are looking for higher returns than others. We tend to be under the belief that, our investor base is very tolerant of deals that will produce a 14% IRR over a 10-year hold. And so far, that's our key trigger point on every deal, is it has to underwrite to a 14 on a 10-year hold net to the investor after all splits and fees and everything is all taken out of the deal by the sponsor, after all costs are paid, including, raising capital reserves up front, all of that stuff. If we can get to a 14 IRR on a 10-year hold, that's our trigger point. Now, as we shorten the hold period to a 5-year hold, I just want to see that it goes up. If it goes up to a 14 and a half, that's fine. If it's 14 and a quarter, that's fine. It just has to go up. On a 3-year hold, it has to go up again. So if that's 14 and a half or 14 and 3/4, that's fine. If it's 15, that's great. If it's 18, that's too much. So then I start gating down my assumptions, because we don't need to show an 18 or a 20 or a 25% IRR to our investors over a 3 or 5-year hold to get them to sign on. So even if I think the deal might do that, we're just not going to underwrite to it. We'll underwrite to lesser performance. So we basically underwrite everything to sit somewhere in that, call it 14 to 16 and a half range over 10 to 3 years, kind of in that order. And as long as we can do that, we've gotten every deal we've put out funded. Now, that said, we also work with institutional investors, and institutional investors look at deals a different way. They want to see an 18 or a 19% gross return over a 5-year hold, and not after splits and fees, but a gross deal level return. And then they carve up the pie from there. On a 3-year hold, they want to see, 19, 20% gross return. So we also underwrite to those. So we're trying to hit all of those targets. The key is finding a price level where you can underwrite to all those different scenarios and have the returns fall within those ranges under all of those different scenarios.
That's a very good answer. That's investors set the market. You and I don't get to say, here's the return, take it or leave it. They decide if what we are offering is good enough to deploy capital for.
Well, and there's more to it. There's more to their decision. I mean, in part, there's different kinds of investors out there. There's what I call the point and click crowd. They want to go to a crowdfunding website, look at a grid showing a bunch of different investment opportunities, and click on the one that has the highest IRR because that's the best one. And it's just not. That they're being a IRR.
That could be very misleading. Let's be honest.
It's extremely misleading.
It's all about the assumptions that go into the IRR.
Exactly. It's all about the assumptions. So, you can take a 20 deal given the same exact income, potential. I could take the same property that underwrites to a 20 and I'll probably underwrite it to a far lower IRR. And this is our biggest challenge in raising capital has always been that there's other groups out there offering higher returns than us. Now, you can offer anything you want. The question is what you can deliver. And, we always tend to underwrite lower than everybody else. And if that costs me a few investors, so be it. I don't really care. Then there's other guys where, I look at somebody and say, hey, you have only done a couple of deals. If I'm going to invest in your deal, I want a higher return than I might with a group that's done 20,000 units. With that group, they'll accept a lower return because that group has a ton more experience. So, the investors are taking a risk-adjusted return into mind, and risk adjustments are market-specific and sponsor-specific and all of those things. I mean, with our level of experience, our team, we've got 105,000 units of multifamily experience on our management bench here. People understand we got the experience to get it done. We don't have to show them a 20% return to attract their capital. They're attracted to us because they know we're a solid operator. So, we found that 14, 15 is that sweet spot.
I think I'm kind of in the middle. People don't expect me to be much higher than you because they know I've been taught by you. So they expect me to be a little higher than you because I don't have that track record to that extent. But they kind of know it's kind of Burke approved, so they should be.
They know that you know what you're talking about, right? I mean, they know that you're thinking about the right things, and someone that they have no exposure to, they don't know what they're thinking and how they underwrite and what their approach is to real estate.
So this is a very interesting conversation. I'm going to put you on the spot, okay? And it's not specifically you versus me conversation. It's a seasoned syndicator that's seen cycles versus a new syndicator that hasn't seen cycles, because this is a prevalent conversation today. Here's the thing. The real conversation, what it boils down to is what's more important, the syndicator, the sponsor, or the deal? I contend, and again, this is not specifically focused on you because I know how you underwrite and what you buy and what your triggers are. But I see a lot of seasoned syndicators who don't underwrite the way you underwrite, and the deals that they float they don't look the way that your deals look, okay? But they're seasoned, okay? So with that being said, I believe the deal is more important because, yes, you could say, an inexperienced sponsor can mess up even the best deal in the world. But you could also say that even an experienced sponsor, very experienced sponsor, could get into big trouble in the wrong kind of deal. And the fact of it is that there's a lot of moral hazard in what we do because as sponsors, we get paid up front when we close the deal. And so it could be said that there is moral hazard in closing as many transactions as possible, as quickly as possible, while the market allows, while there's appetite for what we're doing. Can we get to the bottom of that conversation? Because if a deal doesn't have $300 per door of value add, I am not going to do it. Just because I'm not going to do it. I need that cushion. Why? Because I'm cognizant that I haven't been around this long enough as yourself, and I need that margin for error. For me, the first thing is don't lose people's money. and then worry about how much money you're going to make them. So buy in Class A market and buy the most extreme value add that you can find, so that even if you are wrong and you've made every mistake possible, you are still not losing people's money. So that's my perspective, and that's my kind of message to my investors. Your message is very different. I don't think you are a standard seasoned investor, and I don't think I'm a standard new investor. I've been doing this for a decade, just not syndication. So how do you put this conversation in perspective? What is more important, the sponsor or the deal?
Well, as many people already probably know, you and I like to disagree for sport.
But let's not do it today. I mean, I had a professor in college. He was an old Jewish man that lived through World War II, the concentration camps. He was a conductor. All of us young students loved to hate him. His favorite saying was, "Tradition is laziness." Now, the implications of that are as far-reaching as you are willing to take them. But for the purposes of this conversation, just because there's a little bit of a tradition of disagreement here, let's not be lazy. Let's try something new. Let's try to agree once in a while. We don't have to be all about tradition all the time.
Well, so far we've agreed on most of the stuff that we've talked about. This is probably the one area where we don't quite agree. I think it's all about the sponsor and so much less about the deal. And this is where, investors have to make their choice, when they're investing, hey, is this a good deal or is this a good sponsor? Hopefully when they're working with a good sponsor, the deal is kind of secondary, because the good sponsor shouldn't be bringing a bad deal, or otherwise they're probably not that good of a sponsor.
But we're not talking about, there's a distinction between a good sponsor and a seasoned sponsor.
And I think they're not one and the same.
They're not.
They're not one and the same. You can have an experienced sponsor that's no good. There's plenty of them out there, believe me. In fact,
so you are better off getting a great deal with a less experienced sponsor than a deal with a bad but seasoned sponsor.
Well, that's difficult to decide. I mean, there's really no.
No,
way
it's not.
to know. I mean, it's kind of like, is it better to have fixed rate debt or floating rate debt? There's opinions either way, and the only time you're actually going to know the correct answer is when you look back in hindsight. That's when the correct answer is found, because it's impossible to know. I mean, you could have a great deal with a bad with an okay sponsor. And, you'd have an adverse market cycle that they don't know how to manage their way out of, and it could go and get destroyed. If they have no balance sheet and there's like some negative cash flow event or something that they needed to cover and they can't, the deal needed more money and they couldn't raise it, whatever the case may be, they could be imperiled in a bad market. And believe me, I've lived through it. I've lived through the pain. And if you haven't yet, then my heart goes out to you if you ever do, because it's the most gut-wrenching thing you're ever going to experience in your life. And anybody that hasn't been there doesn't understand the gravity of it. I understand how bad this business can get and how difficult it can get, and have an intense amount of respect for it. You have an intense amount of respect for it for a different reason, because you've heard it from others, and you've had some observations where you've had a chance to see it.
Well, I've lost money myself, but my investors have never lost money. It just it wasn't at this level per se, smaller properties, but I've been through the cycle, so I have respect for what you're saying.
You've seen it. You've seen
I've
it.
seen
and,
it.
And I wrote a $15,000 check every single month for 4 years to ride through that negative cycle on a multifamily syndication. That's how hard I felt the pain. And I've learned a lot of really good lessons. And, now that we've got 105,000 units on our bench here that have been in the business as long as 40 years and have seen multiple cycles and managed through multiple cycles and felt both success and pain. we know how to navigate. We know how not to get tripped up in what we think is a good deal that isn't. We know how to avoid, kind of the worst case scenario. And, it doesn't mean we're absolutely 100% insulated from its effect. But when the going gets tough, you're going to see who's able to manage their way out of it. And, experience and market cycle experience, to me, is incredibly important in surviving to the other side. Having said that, that doesn't mean that there aren't lesser experienced, highly educated, and intelligent sponsors that are going to do just fine, especially those that are extremely conscientious and, put their investors first.
You can name one of them by name,
I don't know any of those.
Well, isn't that wonderful? That's just wonderful.
Oh yeah, we said we weren't going to clown around on this thing, didn't we? But really, it's really about character. It's not just experience. It's a lot about character, and a lot of it is about how important this business is to you and how much you care about your investors. And one of my guys came out of a career working for one of the largest groups in the nation. And he tells me stories all the time. And, they're probably among one of the worst operators out there. And if we ever can have the chance to buy a property from them, it would be a great opportunity to buy because they manage horribly. And so size is not the only determining factor. Length of time in the business is not the only determining factor. Number of units isn't the only determining factor. There's a lot that goes into deciding who is a good sponsor to invest with. Character, to me, is the largest of them, and experience and longevity fall closely behind character. And so it's not just about the deal to me. To me, it's about who you're investing with, and if you're investing with somebody that's really good, they're going to bring you really good deals. If they're not that great, then they're not. And I also disagree with you on one more point, just because it's fun to do this. You said that, the sponsor has a moral hazard because we get paid up front. Well, we don't really. We get an acquisition fee, but that's not the payday.
This is
the payday
true.
Is the promote.
The big bucks come in the end if you perform.
The big bucks come in the end. And so our performance, our real payday, and with a preferred return, generally speaking, we receive zero promote throughout the period of the hold. So we're working pretty hard to make this investment work for however long we own it, whether it's 1 year, 5 years, or 10 years, before we get paid another significant dime for that labor.
This is true.
We're betting on that outcome.
We're underwriting to the IRR, and part of it is we're discounting cash flows because we're trying to be intellectually honest about this. $10,000 today is not the same thing as $10,000 7 years from now. Right. So if we're going to be intellectually honest about this, if we have to hold the property for 10 years and that's when we get paid, the amount that it looks on paper is not really the buying power of that which we're getting paid on this deal, if it happens to come to us 10 years down the line. So, yes, I should clarify that. But having said that, the acquisition fees are rather substantive at times, especially when the deals get bigger and bigger. So it's not like it's nothing.
If you're a one-time syndicator, right? If this is the first deal you've ever done, that acquisition fee is probably the biggest check you've ever written to yourself. And that's where the risk comes from, kind of the new syndication sponsor kind of thing, is that, here's somebody that, probably came from, doing whatever it was they were doing, making whatever, and now they're a syndication sponsor and they're going to get a $200,000 check. When you've been doing this for a long time, what happens is you've built up a lot of overhead too.
Sure.
That
is interesting. Can we talk about that for a minute? I keep trying to get us into some of the specifics, deal level specifics, but I can't because you keep bringing up good stuff. First of all, $200,000. Shoot, I wouldn't even roll out of bed for that piddly thing. What are you talking about? $200,000.
Yes, you would.
Yes, I would. Very much, I would.
You would roll out of bed for $200, let alone $200,000.
Well, now listen. Come on, give me a little bit of credit. It's maybe 10 years ago, yes, but not anymore. What is your typical value add? In other words, what I'm trying to do, we all know where the pricing is, right? It's no secret. We know where the market is. So in order to make a deal work the way that we're talking about, we need back end appreciation. In order to see back end appreciation, we have to have value add. We have to create income that wasn't there when we bought the building in order so that we can capitalize the exit at a higher amount than that which we paid. That activity of creating the delta in the income is a function of value add. That's what we call value add. So my question is, for the deals you're describing, which underwrite to 14% IRR on a 10-year hold, because I know what the pricing typically is right now, because it's no secret, we know where the market is, the only distinction is the value add, where that's what makes the deal, okay? So my question is, what kind of value add per unit are you seeing? How much of it is rental upside due to renovations versus how much of it is recapture due to bad management of economic losses that you are able to reset the classic market for as-is conditions and simply recapture some of that economic loss. So to kick you off, in my experience, we're talking between $300 and $350 per door. I'm in a Phoenix market. My purchase price is very easily 4.5 cap on in-place income, which will look like 5.5 cap by the end of year one, which will look like 8.5 cap on my basis by the end of year four, if I am right with the amount of value add. And that value add looks like about $300 to $350 per door, of which like 2/3 is the bump due to renovations, and 1/3 is the economic loss recapture that we can do. So it's about 100 plus 200. And what it takes for me to do that is about $7,500 per door on the inside, plus whatever exterior, common area amenities we have to spend money on. So that's how the kind of the big picture looks like. It's very seldom to find. I don't care about growing. If I get 2 deals per year, I'm happy as a clam on the beach at tide. If I get 1 deal, but it's really something I want to be doing and putting my name on, I'm happy to. There's a very challenging market. Most things in Phoenix make no sense whatsoever. So it really takes a very, very special deal, which usually happens to be off market, that makes sense. So this whole idea of me developing this huge overhead because I'm getting bigger, that may never happen because I'm just not, that's not my objective. I just want to do as many really good deals as I can find. And I don't really believe I can find that many to where this becomes an issue in the conversation. What does this look like on your end? What is the value add? How much of it is economic loss versus how much of it is value add? How much is the value add on the inside of the unit is costing you to achieve that? And what does that whole picture in broad strokes look like in Brian Burke's world?
It looks different in every market. It looks different with every property. So in Phoenix, it's probably about exactly what you said. If we can't get about $300 to $350 worth of lift in Phoenix, we probably can't make the deal work. But in other markets, we could get $125 lift and the deal will work just fine. And the distinction is that there's a lot of, the value add is not about increasing rents. It's about increasing income. And so if you have a property that's mismanaged and is suffering in occupancy, you could do an extreme value add with $0 in rent lift and increase the income 20% and increase the value of the property an incredible amount, right, with $0 in rent lift. The challenge, I'll start with Phoenix, then I'll move on to another market.
Well, can I jump in, because I have a question specific to what you just said. If you are talking about physical occupancy of 80 to 85%, are you telling me that the purchase price, your strike price, is based on that? Because my assumption and what I am seeing in the marketplace is the seller saying to me, hey, I know I've got 20% of the units vacant, but you, dear buyer, will fill them on day one. So please give me a price that is a function of reasonable market occupancy. In which case, what you just said doesn't work, because I've just overpaid for what's there in order to have it, and now to fill it simply gets me even with where I paid, and now I need value add. Can you comment on that? Are you actually able to?
Sure, sellers want that. Every seller wants that, but the market isn't going to deliver that generally. I mean, every once in a while you'll get a desperate 1031 buyer that, they've got a week left, they have to buy something, and they'll buy based on that story, and that works out fine for them. We wouldn't buy a deal like that. And if we're buying it, you just said that the deals are trading at 4 3/4, 4.5, 4 3/4, maybe a 5 cap, and that's on trailing income. So if your occupancy is suffering, your trailing income is suffering. So that would mean that you're going to pay a 2 cap on trailing income to facilitate that seller's desire to sell at a fully occupied price on a not fully occupied property. And that's just not going to happen.
That absolutely doesn't work. And what it looks like in the IRR department is you're going to get a 12% IRR or something around there on a 10-year hold.
It's just not going to work.
Right.
So, I can pay a 5 cap on in-place trailing numbers on a lightly occupied property and lease it up and increase the value tremendously. But let's look at Phoenix, right? The problem in Phoenix is even kind of the worst owners are sitting at 95 to 97% occupancy right now. So that
you're not going to find that
story does not materialize. The only value add story that materializes in Phoenix is to increase rents, to increase revenue. Now, generally speaking, you can get for a $7,500 interior renovation, which you can do, that's a pretty $4,500 to $7,500 is pretty much the number almost anywhere in the country except like California, in really high price markets where, you can't even change the front door for $7,500. In most markets, we can spend $7,500 and do a pretty substantial interior renovation. And for doing that, we're going to see a rent lift of anywhere between $100 and $150, depending upon what that market's going to absorb. So the difference between that 150 and any other lift is going to be a compression of the delta between market rent and in-place rent. And, but let me focus on Phoenix first, and then I'll go to
I completely agree with what you're saying. That describes...
I know this is the one case where we do agree.
Yeah. So, it seems you've studied on the Phoenix market. Now, you still can't figure a way into the Phoenix market. Maybe you should talk to me because, we
made offers on, I don't know how many hundreds of properties in the Phoenix market. But the problem with the Phoenix market is we underwrite to specific physical and economic vacancy. In other words, if the market is now performing at 97% vacancy or 97% occupancy, we can't underwrite to a continuation of that 97%.
Let me ask you this. What do you underwrite to? What's your total all-in economic loss in your underwriting model for a place like Phoenix?
In Phoenix, it would be somewhere between 9 and 12%.
Interesting. I am right between 9 and 10%.
Yeah. It'd be somewhere between 9 and 12%. And it depends on the property and the sub-market, but between 9 and 12%. So the problem is the property might be performing at 5% economic vacancy right now. So if I'm going to do a value add and I'm going to underwrite to 10%,
right, you have to absorb that into the value.
I have to raise the rent 5% just to get
exactly
my underwritten performance up to the level of
exactly.
And then I have to go another 5% beyond that, or 10% or whatever that number is,
exactly,
to see value add. So I've got to get $300 to $350 of value add on rental income in Phoenix to make a Phoenix deal work.
Well, but Brian, this is true anywhere. Listen, you can't really imagine stabilized operations at anything much less than 8% economic loss. I don't care where you go. I mean,
no, it's true.
you just can't. So what you are describing, that dynamic you're describing, is true basically in every market. I know there are deals being floated all the time with 5 and 6% economic losses or less, as if this is where we're talking about experience.
That's pro forma. Let's talk about actual performance. There are other markets outside of Phoenix where actual performance is not as high. I mean, if you go to Houston, you might see deals performing day in and day out at a 10% economic vacancy or 11% economic vacancy. And, you can forecast that, maybe it's going to go down to 12 or 13, but in Phoenix, you're going from, 3 or 4 to 12 or 13. But in Houston, you might be going from 9 or 10 to 13 or 14. That delta is smaller, and therefore I don't need as much value add. I can get a deal in Atlanta to work with $150 to $200 of lift, but I cannot get a deal in Phoenix to work for $150 or $200 in lift, because the market on an occupancy, a physical or an economic occupancy basis, is performing too strongly. And I call that underwriting to perfection. In other words, the market is currently performing to perfection, and you have to say that the market is going to continue to perform at perfection in order for this deal to pencil, unless you can raise rents $350. So which is it going to be? I mean, you found the recipe. You have to be able to prove that you can get $350 in lift. And out of doing that, probably 100 to 150 of that's going to be from doing a renovation. And the other 100 to 150, you're just hoping that you find a deal where the current management hasn't been doing a rent market survey and doesn't know that the competition is 150.
Well, let me tack something on. It's not so much that the current management hasn't been doing it. The current management bought in 2013. The current management hasn't had to do it because the current management's game was a cap rate compression game. The cycle has changed now, so guys like us have to buy and do the heavy lifting. There's still plenty of meat on the bone because there is that delta on the deals where there is the delta. But wouldn't you love to be them? And you were buying in 2013, where all you had to do was breathe and then exit in 2017 with millions of dollars of value add simply because of cap rate compression.
They're not under duress to need to increase the income. Now, certainly there's a financial incentive for them to do that, but this kind of goes back to the kind of experienced sponsor versus inexperienced. The experienced one knows I can squeeze another $2 million out of this deal by just doing the hard work and keeping up. The inexperienced guy maybe doesn't understand that as well, and they're lazy. And it's like, hey, I'm going to make, $4 million. I'm going to 2x my investors' money in 5 years. And I didn't even have to work that hard for it. And so they aren't. And therefore, they're not squeezing that extra value. They're leaving it on the table for us to do it, which I'm glad that there's people out there that do that, because if there weren't.
Because that's our deal pool, right? That's the only deal pool we have at this point in the cycle.
That's right. That's right.
Okay, let me see. We talked about interest rate. I've covered a lot of ground here. Talked about this. How do you, and I know it's market specific, but how do you underwrite rent growth going forward, considering where we are? I mean, obviously, and you and I have had this conversation many a time before. but you need your rent growth to outpace your expenses, and you know your expenses are going to grow. So it's like you have to be able to rationalize rent growth, but we are where we are in the cycle. So as far as your underwriting thinking goes, where is it?
Most of our stuff we're underwriting at 3% rent growth. We're investing in a lot of markets that are performing, on a historical basis in recent quarters at 4, 5, and 6, 7, 8% annualized rent growth. I can't underwrite to that. Again, this goes back to our earlier conversation at the beginning of this interview about putting on the right clothes for the right weather. To me, seeing a bit of a later stage cycle and underwriting to upslope performance is just a recipe for disaster. So, we're underwriting to 3% rent growth. We're flatlining it. We're not trying to prognosticate that, in a future year it's going to go to 1 or 2 or whatever. What we're hoping is that, we get 3.5 or 4, maybe 5 in year 1 or 2. And, that helps us hedge against what could happen in year 4, 5, or 6, where it might drop a little bit below 3. We have the ability to forecast on an annual basis with different rent growth on every year, but all we're just doing is taking a wild ass guess at what those assumptions should be. So I just tend to go the conservative route.
It's like we think the same.
Oh, that's scary. Don't even mention that as a possibility.
Ladies and gentlemen, I hope you got something out of this conversation. We've been here for a little while. I think I need to let Brian go and kind of wind this thing up. There's a lot of options, and multifamily is a hot sector, and you can understand why folks aren't making money in the bond market. And the equities market is what it is with the gyrations that there are. Certainly the yield is somewhat of an attraction to a lot of people, and it is an integral component of the multifamily space. And so it's easy to understand why so many folks are interested. At the same time, hopefully this conversation kind of illuminated some of the intricacies. Let's say we hopefully dug into the weeds a little bit to help you make intelligent conclusions, ask intelligent questions. Brian, thank you so much.
Yeah, man. Thanks for inviting me. This is a lot of fun.
This was good. Ladies and gents, okay. This was in depth, but I think Brian will agree with just like skimmed the tops of those trees.
Barely skimmed them.
Barely skimmed them. So I want to take a minute to tell you about the event we're having in Phoenix on January 26th and 27th. My partner Sam Grooms and I are having Phoenix Syndication Workshop. It's a 2-day event in downtown Sheridan. On day 1, we're going to be going through the underwriting process. We're going to be going line item by line item and having in-depth discussion of all of these things that we touched on today, plus a lot more. On day 2, we have an SEC attorney scheduled to come speak with folks. We have a property manager with 20,000 units, probably more now, under management. We have a banker who is busy lending deals on these kind of things. We have a few speakers, but most importantly, what we're going to spend time doing on day 1, which is underwriting a property. This was an acquisition that closed 4 months ago. We're going to put you on the bus and take you there so you can see in person what it really looks like. It's one thing to understand the numbers. It's another thing to really see the dynamics of what happens at the property and what that really looks like. We're going to have the property manager there to kind of help answer the questions and put in perspective all of those dynamics. This is going to take place on January 26th and 27th. If you would like more information, please visit my website, which is www.justaskbenwhy.com/Phoenix Phoenix. The registration is going to be open for a couple more weeks. The cost to attend is $2,000. This is a two-day event. We will provide some of the meals, not all of the meals, and we're not providing the hotels or anything. You guys are on your own. This is probably not for new investors. This is probably for more seasoned people. For those of you who have a portfolio of 10, 20 rentals, and for one reason or another, understand that your intellectual growth and your growth in this business requires you to understand what we do in the world of syndication of large multifamily. This may be for you if you are interested in deploying capital. I know a lot of the people that are registered already, they are high net worth individuals who would like to know how to back out our assumptions when they receive the offering memorandum from Brian, myself, or anybody else. You have to know which questions to ask. So coming to learn which questions to ask, okay, to be able to break down the underwriting model and to ask the right questions to decide whether or not deploying capital in this deal or that is a good idea. So that's kind of gives you the big picture view of what this event has entailed and what we're hoping to accomplish. It's not a very large event. We're going to have up to 50 people. It's going to be very detail-oriented, very focused. We're not going to be doing push-ups. We're not going to be doing hoorays. We're not, none of that. We're going to be doing really hard. I'm showing up to teach. So if you are interested, please visit my website, www.justaskbenwhy.com/Phoenix. You can reach out to me at ben@justaskbenwhy.com, and you can reach out to Brian at Brian, was it Brian Burke? Was it, what's your email? Brian Burke at Praxis.com.
Nah, you got it all wrong. It's Brian at praxcap.com.
Shoot. Brian at praxcap.com. I apologize. Brian at praxcap.com. Gee, Chris. Okay.
It's a new year, Ben.
Say it again. Say it again.
Brian at praxcap.com.
Thank you. Ben at justaskbenwhy.com. justaskbenwhy.com/Phoenix. Happy New Year, everybody. Hopefully you found this conversation entertaining a little bit and educational a lot, somewhat. From Brian Burke and Ben Leybovich, thank you for joining. Have a great day.